I'm extremely, the key word is scared. What gold is signaling here. Every major risk asset on the planet is underperforming gold, and gold is the most expensive versus most moving averages. You can go from 100 to 200 a day to 40, 50, 60 months to 16 to 20 quarters. Then it's versus every single major peak in its history. It's that rich, it's that extended, and we all know it's a high since 1979. And what's it telling us? It's telling us, number one, gold loves President Trump. The nuance is Mr. Trump saying the shutdown might be good, and of course pushing back in the Fed. But the key thing is obviously the geopolitical, and I like to point out what it means now for all markets. Is this gold is just at $4,000 an ounce. There's FOMO in it. ETFs are flowing in really fast, and I put on my spidey senses as a risk manager. Yeah, this is probably when you're supposed to be lightening up a little bit.
Okay, you gave us a lot to think about there. What are the conversations in Greenwich about gold specifically? Do others feel similarly concerned? Do they see this as a signal that is flashing red and we're going to get some kind of consequence in the near term, in the next 3 to 6 months?
Well, Ray Dalio, I think, nailed it yesterday. I was interviewed by Lisa Bromwich, who was awesome. He said, she asked him flat out, is this a bubble? Is it overextended? She said, yes. And he said yes, and said gold is part of that. So I think people are quite concerned. But also, and then you talk to people like the crypto people, like, no, it's nothing but going up in terms of crypto assets. So I like to point out things like Bitcoin, gold's alternative, the digital alternative, is the same price versus gold since 2021, yet it trades at 2 to 3 times the volatility. The S&P 500 total return is the same level versus gold since 1997. That's very disconcerting. So I look at this as gold potentially, to me, is telling us, yeah, you should be getting out of everything that's gone up, and gold's one of those things that went up. So I'm looking at it as a very concerned risk manager. And to me, gold is also, it's just not supposed to be, when everybody's yelling, gold, there's a lot of yelling right now, you're supposed to be selling.
That's right. When did, like for the stock market, they say this, valuation doesn't necessarily kill the stock market. It's usually some external event, whether it's Fed policy, something external. In a commodity world, Mike, when you get something that's just ripping like gold is, what stops it usually?
Usually, you nail it, Paul. Usually the higher price, that's a key thing. All commodities have a high price cure, and the least elastic to that is gold. So you look at crude oil. Why is crude oil getting hammered? Because it went up too high in 2022. Corn, same thing. Soybeans, grains, they went up too much, they're heading lower. The key thing is you look at gold versus all commodities now, it's almost at a record high, it's too expensive versus almost everything. With the exception of one key thing it's still cheap against, that's the S&P 500. So I look at that ratio right now in ounces of gold. The S&P 500 right now is about 1.66. The peak during COVID was about 2.6. Historically, it goes back to 1 to 1. And my fear is it might go back to 1 to 1. Particularly what gold loves is the fact that the S&P 500 is about 2.3 times U.S. GDP, and it's about 70% of the U.S. market cap. So to me, what gold's telling us is U.S. stocks are somewhat expensive and it's an alternative.
We talked about how ETF inflows and central bank buying are really supporting gold right now. What does positioning look like here? I mean, clearly this is a crowded trade, if not an overcrowded trade. If there was something to stop gold's momentum, how painful could it get for folks out there?
Well, Scarlett, I'm glad you went there because the last data we had from positioning, certainly futures, was nowhere near extended. About 33% of total Coleman's open interest was net long. That's managed money, net positions, that's the specs. Last year, the peak was around 45%. So they're not over the skis. ETFs are really starting to kick in, but they had 4 years of outflows. They're kicking in now, up about 17%. Put that in this year, put that in context, in 2020, they're up about 29%. So around that pace. So the market's not really showing major signs of overbought. Central banks are buying, but in terms of prices, that's a key thing I look at in terms of gold historically. When it gets this stretched, you should be cautious rather than greedy. And I think people are looking for an alternative and getting a little too greedy at 4,000.